We put out a release announcing two changes to the live cattle futures contract to enhance the hedging effectiveness of that contract. One, we're going to be applying a seasonal discount at Worthing, one of our delivery points, of $1.50 per hundredweight in October only. And that's to allow the delivery value to better reflect the underlying cash market and cash values in that region. And then we're going to upgrade the quality specifications also by moving the choice percentage to 60% from 55%, and then the select percentage down from 45 to 40%. So again, a change that allows the futures contract delivery terms to better reflect the underlying cash market. What location discounts do, premiums or discounts, is they attempt to align the delivery value at a location with the underlying cash market. So we had an independent study done by Informa Economics which looked at cash price differences across our delivery points. We have 13 delivery points in the live cattle contract, ranging from Texas to Oklahoma, Kansas, Nebraska, and Iowa, southern Minnesota, or South Dakota in Worthing. So what that study found is that the cash price in that Iowa, southern Minnesota region is consistently below the other regions in the fall of the month. And this is reflected by the October contract. Therefore, to ensure our contract is compliant with CFTC policies and reflective of the underlying market, we'll be discounting deliveries against futures at Worthing by $1.50 per hundredweight for that October contract. What's happened as the feeding industry has gradually moved to the northern plains where there's cheaper feed. Distillers dried grain is more available because of the ethanol production in that region. That's really closer to the corn supply than, say, Texas and Oklahoma and Kansas are. So livestock production, fed cattle production, has grown while the slaughter capacity has not really kept up with the increase in production. That means that those cattle produced in that region have to be transported often farther away to find slaughter capacity in the fall when this supply is heavier, and that transportation cost then is reflected back in the basis in that region. This is very common in our other agricultural contracts. Our grain contracts all have premiums and discounts. Our soybean meal, soybean oil contract have them as well. So it's a very common specification in agricultural contracts. Haven't had them in cattle till now. This is the first one we'll be implementing in the live cattle contract. We have a couple of contracts where they adjust based on a formula in the contract. The soybean meal and soybean oil have what's called an automatic adjustment mechanism, and that allows us to reset those annually. Our corn and soybean contracts, we're resetting them for the 2019 contracts. They have been fixed since 2000 when they were implemented on the Illinois River. Wheat, those have just been implemented in the last few years. We try not to adjust these too frequently, but we want to make sure that they are reflecting the underlying market as closely as possible. So we'll look at them, we'll monitor them, and if they need to be adjusted, then we'll work with the industry to make those adjustments. We want to make sure that our contract is working as well as it can for the commercial end users. We think these changes are enhancements that get us closer to a hedging tool that will better reflect the cattle that they're hedging in the cash market.